Welcome to Season 2 of the Crypto Pulse podcast, your ultimate guide to the world of crypto, Bitcoin, and world economics. We're here to guide you through the crypto universe with thought-provoking topics, in-depth knowledge, and information to help you make informed decisions. We'll also be interviewing some of the best minds in the industry, such as CEOs of crypto projects, traders, economists, authors, and development teams from around the globe. And now for the episode.
Kevin, welcome to Crypto Pulse. We're super excited to have you on the show. We've spoken a bit behind the scenes about what you guys are trying to do. So before we go into what MakerShaker is and the problem you're trying to solve, maybe you could tell us a little bit about yourself and what made you interested in the Web3 space to start with.
Yeah, hi guys, morning. Look, thanks for having me here. Appreciate it. So if we roll it back a little bit, my background is in asset finance. I've been in asset finance for about the last 20 years or so. And then I moved into lending around about 2011. But principally, I was involved in real estate, and we were getting terms in on a particular transaction, and realised maybe we were on the wrong side of the table, and the lending side looked a bit more attractive at that point in time. So we started off very much as like we've done in the NFT lending space. We started off piecemeal lending. That was myself and a few family offices in the UK, and we quickly came to the realisation that we needed our own platform. And there were a couple of reasons for that. One, there was a regulatory piece in terms of the products that we could push out. Secondly, we wanted to get some insight and have our own branding, but we wanted to kind of build this awareness of what we were as a business and what our values were. And we hoped that would attract a certain type of borrower as well. So in 2013, we acquired a kind of small, medium-sized asset-backed lender, and which was actually a founding member of the Association of Short-Term Lenders here in the UK. So it was a well-known brand, and I ran that business. I was a CEO of that business for about 7 years. Took it through full regulatory approval, and I suppose the key aspect that we're bringing into MakerShaker, which we'll go into further on, is that you lend to a person, right? You secure, when you lend to that person, you secure against the asset, but it's really the person that you're dealing with is the key point. And then, Kevin, to go to your question around the Web3 space, I've been involved in some aspects of the metaverse since 2006, really. So I was an investor, a cornerstone investor, actually, in an MMORPG for mobile. And I got involved with a guy called Richard Bartle, who actually designed the first ever virtual world. And he at a lunch told me, Kevin, you need to be reading Snow Crash if you're interested in this space. So I suppose that was my lead into kind of gaming. And that led into my awareness of what blockchain was and what Web3 is. But to answer your question specifically on Web3, because the DAO aspect that is really kind of caught my eye and is really exciting. It's this idea that Web3 is decentralization. And what it does is it provides opportunities for individuals and the collective as well to own and change outcomes. And then also the opportunity for communities to kind of innovate without a traditional corporate structure. And for me as an entrepreneur at heart, that's something that really resonates, this idea that we can have DAOs and we can change the way that we work and interact. And we can actually do some really cool stuff outside of the traditional confines of what the corporate world looks like.
Love that. So, I mean, DAOs is a very, very interesting topic. And I think we've seen various incarnations of that, and we're very, very early on. But like you, we're super interested in sort of the democratization of business and how other people can get involved that aren't, typically like your traditional shareholders of a centralized business. So I think this space is very new. What I like is that you've got a very traditional business background, you've got really incredible business experience, and you're coming into this new space. So maybe you could tell us a little bit about what MakerShaker is and the problems that you're trying to solve with the platform.
Yeah, sure. Look, MakerShaker is a finance platform for NFTs, and we view ourselves predominantly as an infrastructure play for NFTs as they are at the moment, but also tokenized assets as we move forward. And what we're aiming to do is we're aiming to provide liquidity to holders of NFTs in the form of loans. And the way that we're doing that is we're going to provide certainty to borrowers in terms of terms and pricing by us underwriting loans at the outset. But what we're hoping to do is to improve those terms for borrowers by providing liquidity to them through a vault process. So we're effectively P2Pool. But the underwriting for us at the start and third party, what we call lenders or makers coming in, we hopefully will drive down pricing. And some key aspects of MakerShaker, it's our business background. As you mentioned, Kevin, we come from a lending background, and that regulated lending background, there are some aspects of that which run through in terms of the way that you treat borrowers, ethics, fairness, customer outcomes. Regulators around the world talk about customer outcomes all the time, and that's a key cornerstone of what we're trying to do at MakerShaker. We're heavily focused on fairness, trust, and community as well. Again, we think that's really important, and we don't think lending should be transactional only. We think good lending and good borrowing is where there's some insight or some sort of relationship between lender and borrower. So those are things that we're starting to introduce slowly. We view ourselves as an infrastructure play, and we think that the provision of liquidity, it's a big problem that needs to be tackled, not just by us, but some of the other platforms and other players in this space, if we're going to onboard the next wave of NFT users. And for that, we think it needs better UX, better UI. We think the price discovery needs to be more efficient. And as we touched upon earlier, there needs to be fairness to the borrowers in the event that they don't repay or they can't repay their loan. And for the lender themselves that are coming in, they need to be able to choose what their risk appetite is on a particular asset. So at high level, that's what MakerShaker are doing.
Okay. So just quickly on the liquidity side of things, you say that you're going to be providing liquidity, and there's a current problem there. How would that work exactly, and what are some of the liquidity issues that you see currently in the space?
Yeah, well, look, if maybe I can use some examples of the current platforms that I've been using, which are really good, and that's and just see some of the things that we're maybe trying to do differently to those. Sure. So predominantly, look, we've been lending on Niftify. It's a great platform. They've got lots of transactional volume, and as a peer-to-peer lending platform, they've done a lot of things great, and they're innovating relatively quickly. But in terms of the borrower experience, what you have there is you have your asset that you're putting up as collateral, and you go through a price discovery process, which is relatively inefficient in that you have different people pitching different terms to you. So that's the borrower experience. But from the lender perspective, what we're doing slightly different is that you've got one particular asset. Let's call it a mutant ape, just because I own one of those and it's my PFP. Right? Let's use that. So I want to post that up, and I want to borrow against that. What we have at the moment is you've got individuals that are pitching terms to me, and that's great. I might come across the individual that I want to borrow from that is providing the terms that I want. But what we've seen from our background in lending is that sometimes actually by blending 2 or 3 people together, or 4 or 5 people, what you get is that collective blend of what their risk appetite is actually produces a slightly better deal for us. And that's really what MakerShaker is about. With this P2Pool concept, whereby we have one borrower on one side, But on the other side of the equation, we've got a multitude of lenders that are coming in, providing funds at different rates that are all blended together, and hopefully they hit the borrower at a slightly lower or more competitive rate than if one person is just lending to them.
Kevin, I have a question just regarding the volatility in sort of appraisals and valuation for NFTs. Because obviously we've seen this sort of asset-backed financing in the traditional finance space, and using real estate to back finance in that way. But NFTs, I mean, they sort of, it's quite a secular market, and we see the sort of these huge price spikes and then these massive dips. How much of a problem is that for you and lenders? I mean, if the value of an asset drops considerably because of the market conditions, is that something that you foresee being a big problem?
It's a great question, right? This isn't a new problem, though. This is a problem that's existed for, I imagine, hundreds of years. Right. And let's just talk about what we were doing in our lending business, and that applies. That's directly relevant to the volatility that's happening in this NFT space. So when we were lending against assets, real estate assets, we weren't taking that traditional kind of first charge position, which is the secure position. We were taking that kind of second risk profile, which meant that if the asset price fell by 25% in value, that we were at risk of losing some of our capital. So in the real estate space, so that's a starting point. We were then ramping that risk profile up. So where we were taking, for example, development risk. So you start putting layers of risk on board, and you are exposed as a lender to that. And so we don't view that any different to the volatility in NFTs. So what we have is a different set of learnings that we've got from the lending space, lending against real estate, that we're then bringing on board and hoping to deploy into the NFT space. And there are certain things that you can do, and I can touch upon them now or maybe later, but understanding who you're borrowing to, not their personal details, where they live, where they're from, their name, but just understanding their motivation for it, right? That's really important, because then you get an insight as to how they're going to react if the market goes against them. So and that drives positive outcomes. I suppose the second thing you can build in, we are doing, for example, when we're lending on other platforms, we're running an API on their wallet. And what that does is it gives us a credit score on them, and it tells us what rate of return they've been generating in the past, their total return, their return on investment, gives us an insight into how long they're holding assets typically. So these kind of things help in order to kind of mitigate that risk of volatility in this space. And then there's the traditional stuff that other people are doing, which we're going to be doing as well, which is, look, you look at the profile of an asset, you look at the historic volatility, and you price your LTV off that, and then you price your length of your term. So all of those things, from what existing players are doing, we're doing, and old learnings, but then they're not, as I said at the start of this particular point, they're not new problems really. They're problems that exist in the NFT space in the same way that they exist in the real estate space, in stocks. People, if you look at share volatility, people borrow against stocks. Some of the tech stocks are down, well-known tech stocks are down 70, 80, 90% since November last year. So across all different asset classes, you've got these problems, and people are up for people that are trying to deploy capital that understand risk, and there are obviously lots of people that don't. And it's a new space as well. People are learning and adjusting for these risks. I don't think it's a barrier. I just think people need to be cognizant of these issues, which I think a lot of people are.
I think it's true that because the market's so new and it's very retail sort of millennial Gen Z investor types that have typically gone into NFTs at the early stage. They're probably not used to managing risk in the way that somebody does when they're buying tech equities and have done it for the last 25 years or something. So I just wanting to go back to your point about a credit risk profile for somebody, and the fact that you can do that on their wallet. To me, that seems like almost an impossible thing to do, because people have different wallets for different things. I don't know how many wallets I've got, several. So how would you get a profile of somebody based upon their wallet address?
Yeah, correct, Kevin. There's a flaw in what we're doing, and this is one of the reasons why we've moved to MakerShaker. It's back to the old days of you need your platform to get better insights. So what we're doing at the moment is totally flawed. We're running API on a wallet, and it's just giving us an insight on that particular wallet that is looking to borrow, but it doesn't take into account the other wallets that someone owns. So absolutely. What we're hoping as we move forward with MakerShaker is we've got this community approach, and what community means is we get better insights from people. So we're not after doxing people. We're not looking at KYC, AML. We will obviously respond to what the regulatory environment is like around the world, and we will comply with that for sure. But what we're hoping is that as members of our community, we start to get to know each other a little bit better. We get better insights. And then those flawed approach that we've got at the moment of running API on wallets, and then looking, for example, on what their PFP might be, looking at this is manual stuff, looking at Twitter. Hopefully we've got a better understanding of the people, so we can run different kind of parameters on them with their consent, of course, so they understand it. Because there's a flywheel here that what we're trying to do is we're trying to educate borrowers as well, in that a bit more information, if they're able to provide, what it'll actually do is it'll lower their interest rate. So that's a really important aspect of this community approach, really. And I look, it's this is blockchain, this is NFTs, this is Web3. People are totally entitled to keep their personal information to themselves, and we're supportive of that, absolutely. But at the same time, if we can educate people and make them realize that, hold on, if you give us a bit more insight into the all of your wallets, for example, or what it is you're borrowing this money for, or what it is your vision, or those kind of insights, really, what it enables us to do is we've got better understanding of them as a borrower. We can provide better terms because we can understand the risk profile better. That lowers rate. And what it then does is this flywheel that we talk about internally, is that as rates get lower, that attracts, it does two things. One, people start to volunteer a bit more information because they can see it directly benefits them. And secondly, it attracts other types of borrowers that are attracted to those lower interest rates. And then that just keeps going around. So that's a key component to this community piece of our business in terms of driving better outcomes for lender and borrower.
I think that's a really unique way of looking at things in this space, because the more people borrow and the more people lend, the more credible they'll be. So I guess if I've done provided capital for maybe 10 loans and I've borrowed 5 and I've met the terms and I'm seen as a good actor in the space, then more people would effectively come to me and offer me things or want to borrow. So is that kind of what your vision is, that the more good that's done in the community, the more elevated that person's particular profile will be?
Yeah, absolutely. Look, this is the community aspect that needs to be, that we're totally focused on. It's just, as we, it's like everything in life, it's business relationships, it's personal relationships. When there's more trust, that premium that is built into the lack of trust, which exists across all of the lending space across the world, lack of trust means increasing the premium. And that's whether you're borrowing money for a house, a car, an NFT, or you're putting money into a DeFi protocol, which we've seen in recent months. When trust evaporates in a particular protocol, the interest rate blows up. So by having a community aspect, and where people's profiles and their community standing really increases, what it enables them to do is they're able to borrow at better rates. And that's notwithstanding the kind of reward piece that we're hoping to build in, which should hopefully drive down rates as well. But can I just say one more thing, Kevin, which is directly related to, which isn't quite your question, but it's directly related to our learnings from when we were running our lending business. So when we bought that business in 2013, that was kind of a process-driven business. And what we were able to do by we changed the way that business was focused in terms of getting insight on people. And we were able to improve our returns by 60%, 60%, by having a better understanding of who we were dealing with, rather than having a process-based business where we got very little insight into who we were dealing with. So we've got real world experience of what this concept does. One, in terms of providing better outcomes for lenders, but also in terms of our ability to push down and drive down the interest rate for people that are borrowing as well.
So where are you in terms of the development and the evolution of the platform? Because I know this is super early at the moment.
So we haven't really launched. We've been working on this for about 3 months. 3 months now. Obviously, we have a presence and a landing site at MakerShaker.xyz. The reason for kind of getting involved and reaching out to you guys and starting to put our name and our brand out there over the next few weeks is that what we're trying to do initially is we're trying to onboard 25, 50 core community members. And there's a couple of reasons for that. One, we want to talk through in detail with those initial core community members what our protocol looks like, which we haven't drilled into detail on this call. And maybe this forum's not the appropriate forum for doing that. But what we want to talk through those potential borrowers and lenders, what our P2Pool protocol looks like, and just make sure that it is, so we have a view that it is what the market wants, but just to hear back from people that are active in the space and tweak it or refine it. I suppose that's the first reason for putting ourselves out there and reaching out. The second reason is that we, and it's a fundamental aspect, we want to reward early adopters and also community members going forward. And we've gone live with this in terms of our FAQs on our website. And what we're saying in the public domain is that we haven't come to a conclusion as to what that reward system looks like.
Right.
And what we want to do is we want to work with those initial core community members, and we want to get their input and also for them to steer the conversation as to what they want that to look like. And that reward piece can go down multiple different avenues. So I suppose that's the reason that's the initial stage that we're at. Kevin, in terms of larger or longer term roadmap, we're hoping by the end of Q4 to be writing our first loans. That would be via our smart contract, but off platform effectively. And then next year, what we're hoping to do is we've got this dynamic pricing concept, which we'd like to talk to our core community members about, which we think is pretty cool. And we want to test that in the marketplace with a view to a full launch of our platform later on next year. So those are kind of the shorter and medium term milestones and our roadmap as we see it at the moment. But the key aspect of that is we want to engage people early. We think we've got a lending background, which we do, but we don't have a great deal of lending in the NFT space because nobody does. Right. So we want to introduce people. We want to kick stuff around people that are early as well and make sure that we're building something, not just for the community as it looks now, but also building in for what we think that this tokenized space could look like, because that's really why we're getting involved in this. It's this idea that in the future, everything is going to be an NFT. It's not just, it's not just traditional art or new art from entrepreneurs. It's the idea that we can have physical, hybrid assets which are tokenized, human capital being tokenized. So we want to make sure that we're building something that is ready for what the future could hold for this space.
Yeah, and that actually leads me on to a question that I had, which is, you sort of say that you think you've identified a need for a product like MakerShaker, and all of the discussions that we have on the show tend to lean that way as well. We had a guest on recently that was providing the staggered payments through crypto, and sort of showed that the younger generations were moving away from credit cards and typical loans, and were looking for sort of alternative methods of payments. What is the main benefit that you see for people that need liquidity to use a platform like MakerShaker versus using something like a traditional high street credit card?
Well, there's two aspects to this, I suppose. The first bit being, if we just look at blockchain and Web3 space and what exists in that space, and then maybe roll that out to the real world in terms of credit cards and access to loans. Within Web3, you've obviously got a lot of, you've got DeFi protocols, and you've got a search for yield, really. What people are doing with their funds is that they're chasing yield through these DeFi protocols, and there's certain aspects of that. I know your question is aimed at the provision of liquidity, but there are people that are funding, that are chasing yields through protocols where they don't understand what they're lending out. So I suppose that's our view, and that's really important. Okay, for a lender, okay, we think it's really, really important to understand what it is you're lending against. And I know it sounds an obvious point,
but it seems straightforward.
Kind of useful.
I know, but. But it gets lost on everybody. Okay, and I understand that. Okay, we've all been there before. But we have to go back to some basics here. Okay, you want to understand, if you're lending money, what you're lending against. You want to understand what the risk profile of that is. You want to understand what the liquidity of that is, and you want to understand the time frame. Okay, so that is a fundamental. And then obviously we're doing things from the lending perspective in terms of underwriting that and creating a vault where we bring our learnings from the past. And we've talked about that community bit, so I won't go now. In the real world, all borrowing is recourse. Okay, so it's full recourse. So it's irrelevant what happens to the value of your asset. If, for example, your asset drops below your total amount that you've borrowed, you're still on the hook for the difference. So say, for example, you borrow again. In the real world, let's say, for example, you buy a house for 500,000, you borrow 400, the value of that asset drops to 300 and is sold, you're still on the hook for the 100 grand. Okay, so that's recourse, and that's across credit cards, personal loans, everything is full recourse. Okay. In the NFT space, you predominantly have non-recourse loans. So what that means is that you can walk away from a loan if you're a borrower, and there isn't recourse to you. You will lose your asset. This is the existing structure for the current lending platforms. You will lose your asset if you default eventually, but you won't be on the hook for the difference between what you borrowed and what that asset was predominantly was actually sold for. So that is attractive for a borrower. Okay, and so what you're doing is you're not putting all your eggs in one basket. You're borrowing against a particular asset, and if that asset goes south or sour, you are constrained or capped in terms of the total amount that you will lose. So that is really attractive for borrowers, and that is what most of the NFT lenders in this space are doing.
Yeah.
So that is attractive to borrow in this space rather than the real world. And then I suppose if you look specifically at MakerShaker, why MakerShaker versus those other platforms? There are some core aspects around it. One, we hope for better price discovery. One, we've already talked about. Secondly, we've already talked about this concept of driving down pricing. But two areas that we haven't really talked about so far is we think borrowers should have better outcomes in the event that they don't repay. Effectively, they default. So we get to the end of the term, and they, for whatever reason, they don't repay the loan. And so what we're seeing in the market, there are different mechanisms for different types of lenders in this space. So you have an auction mechanism, for example, with BendDAO. You have with NFTFi, you've got an ability to extend at the will of both parties. But what we think is fairer is that for borrowers, they have an automatic period when the loan expires where they have an ability to agree an arrangement with us, to be decided what that looks like, but they automatically have a period of grace. And then secondly, and this is really important, in the event that the asset, the NFT is taken away from them, in the same way that across this whole space, NFTs are removed from the individual if they default. If eventually after that payment or grace period, they still don't want to repay, or they still don't have the capital, we have this mechanism which we're introducing, whereby the excess over and above what the debt is gets repaid to them. So let me give some numbers on that. Let's say you've got a mutant and your mutant is 20 ETH and you've borrowed 10. You get to the end of the term and it's worth 15, but you're still not in a position to repay. And across this space, what sometimes happens is that the asset was worth 15, but with debt on it of 10, that asset gets removed from you. And not only do you lose the asset, but you also lose that 5 of equity that's inbuilt in the asset. And we don't think that's fair for a borrower. We think, and in the traditional lending space, if, for example, our property scenario we had before, where you borrowed 400 and the asset was worth 500 initially, if you then sell the asset for 450, that 50 gets returned to you. So we think that those outcomes that exist in the real world, we think that those should apply in the NFT lending space as well. So it's fairer outcomes, but with capped risk. I suppose those are the attractions why people should be borrowing in the space.
Yeah, it's a really great way of doing things. And I wonder, just to pick up on one of your points, I mean, when you're defining the terms of the loan to the borrower, are you guys interested at all in how the borrower are using the proceeds of the loan? I mean, if they were, for example, if they disclosed that they were going to put it into some sort of high risk protocol, and they were, expecting to achieve some yield from that, which repaid the loan. I mean, do you sort of look at the risk that far in, or is it, it's straightforward? And
it's a great question. Look, we're all early in this, and so it's new. So there will be learnings we get in the future. But for sure, what we've learned in the past is, and there is a second strand to this, which I think is more relevant in 12, 24, 36 months, which I would like to address in a second. But at the moment, with NFTs as they are, perhaps there isn't quite the emotional attachment to an NFT. Okay, so that isn't quite your question in terms of what they're using the money for, but there is something about what the NFT means to that person, which is really relevant, okay, in terms of what the risk profile looks like. Right. And I will give some examples about what future world NFTs could look like. But at the moment, we are keenly interested in what they're doing with the funding.
Sure.
Principally, and what it does is it drives down borrowing rates, right? So if, for example, we can see a particular, which we can get some insights already. I know, Kevin, earlier on, I think it was you, Kevin, that suggested that it's imperfect getting an insight on one wallet. And it is, we totally agree with that, right? But sometimes you do get insights on borrowers in terms of these are people that are holding assets longer term. Okay, that's really good for us. Okay, we have been and like to lend against those type of borrowers. So this is the type of person where we can see that blue chip has been in their wallet for a long period of time. So there's a risk, obviously, around NFT being stolen. So we like it to sit in their wallet for a long period of time for all of those obvious reasons. But notwithstanding that's the type of borrower that we have been lending to traditionally. But there are insights that you can get from someone where you can see that they're clearly flipping, and within a space. And actually, that type of borrower is not unattractive to us either, because what we can see is that person has if we structure the loan at the correct LTV and on the correct time frame, what we can see is that person is bringing liquidity to them quite frequently as well. And so that's a positive thing in terms of ability to repay. there are other categories which we've seen which are less attractive to us, and those, for example, would be someone that is seeing a particular opportunistic play. So, for example, where we get a small insight, and these are difficult to ascertain, right? So this is this imperfect world where we're working in, but where, for example, we get an insight, maybe through their PFP and maybe some postings on Twitter and things like that, where we get an insight that what they're trying to do with the loan is they're not trying to make a play on NFTs, but they're trying to make a play on what ETH might do, for example.
Right.
So what they're trying to do is they're trying to take liquidity off the table, convert that into US dollars, and what they're hoping to do is then in the future convert that US dollars back into ETH at a lower price.
Right.
Okay. So where we get that insight, that is not attractive to us, because what it means is that there's a higher risk that they're not able to repay, because that is obviously totally dependent upon their thesis working out, and that's
very rarely does.
Yeah. Look, that's problematic. So there are things, and again, it goes back to this point that we're trying to evolve. We're trying to bring in these insights. What it means is that lenders get better results, borrowers get reduced terms, and all these three examples that we've given, they're happening across this space. And if we can understand a little bit better what they're doing, and look, we were in the lending space, right, traditional lending, and we're familiar with the idea that if someone tells you what they're doing with it, isn't always what they're going to do with that funding. So we get that as well. But we're hoping that if we have a community over time, consistency of what people say they're doing should improve, and the community aspect around that should encourage it as well. So it's a real driver for what we're trying to do, and it's a real cornerstone of kind of the MakerShaker values and also our concept.
Yeah, and I suppose one of the other major factors that really goes in your favor is the fact that, working in the Web3 blockchain crypto space, is that the majority of this stuff is public information. It's on a distributed ledger, and it's, there are tools that can be built that, will give you deeper insight than perhaps in the traditional finance markets.
Yeah, that's really, look, that's actually one of the reasons why we got involved in this space. Because one of the flaws that we've seen in the traditional lending space is you have, again, imperfect information, right? And because if you talk about real estate lending, our background, you think you're getting a wave of information, but from a particular borrower, on a particular asset in a particular town or a particular village, but there are factors that can that change the information in a non-positive way. So, for example, the value of the property is a friend of the person that's borrowing, or they're a key client, or that particular asset on that street is imperfect, or there's something being built around the back, or the road, or they've got noisy neighbors. So all of this information is imperfect in the real world. What blockchain does, and also NFTs, is you have a lot of visibility, right? So if you look at blue chips, there's a lot of visibility on what floor assets are selling for. You could see every single transaction. Okay, in the real world, if you look at property, for example, even a property next door to someone that sold their house 12 months ago, you've got an idea about what that asset might be worth, but you don't have perfect information. What blockchain does is it opens up this wave of information so that people can start to compile and assemble data, and everyone's doing it in different ways, right? We've got our own unique take on it, which is a bit more focused on the individuals. Others are running some great protocols that we've seen, a great API on volatility, on traits for particular blue chips, and that stuff is really cool across the space. And I think that over time, what it'll do across the board, not just MakerShaker, but across this space, is it'll improve lending rates. The more visibility we get on the asset that people are lending against and borrowing against, that should drive down rates and we should have more efficient pricing on it. I suppose the strand that we're trying to bring in is that insight on the individuals as well, not doxing them, not where they live or which country they're from or their name, but just those insights in terms of the questions that you've asked. What are they using it for? What have they done in the past? Are they a holder? Are they a flipper? Are they taking a bet on the ecosystem? Those insights should improve outcomes for everybody.
It's incredible. I mean, I think this is such a complex issue, isn't it? And hopefully that with some community engagement that you'll have like I guess there's never a final product or final platform, but certainly something that you can go out to the market as a version 1. So on that note, how you mentioned that you want to get people involved in on a community basis. So to help you sort of steer what might work for your target demographic audience, how will they be incentivized and rewarded if they take part?
Yeah, we don't know the answer to that, Kevin. I suppose what we want to do is onboard those core 25, 50 community members, and they can do that in lots of different ways. So they can go to our Discord, follow us on Twitter, but we have this registration form on our website, makershaker.xyz, for registering, and they can tell us if they're more interested being a maker, a liquidity provider, or a shaker, a borrower. So we want to onboard those core community members, and we want to discuss this with them. Okay, so we've got a blank canvas here in terms of what we could do. So things that we put out in our FAQs as concepts are, we can reward people by having reduced rate loans, or maybe interest-free loans, if, for example, they're a borrower and they're actively participating. Everything's on the table, so nothing's set in stone. These are just ideas that we're putting out there, and one might percolate to the top. So that's from a borrower perspective. We're obviously, as part of our business model, MakerShaker, we're taking a fee on the interest that is earned by lenders, and we're a lender as well, right? Don't forget, MakerShaker, we're providing liquidity as well alongside all these other lenders, but we're taking a fee. So I suppose one other concept that we've talked about internally is sharing that fee with the community. A significant sum of that, I don't mean 5-10% of it, I mean 50, 75, 80% of that fee, sharing with that community. Other aspects we've talked about internally, some sort of utility token. And then obviously, we've talked a lot about at the very start of this conversation about what attracted to us as to me in particular to Web3 and this idea of a DAO. That's also something that we'd like to discuss and talk with our community about. So and then obviously there's NFTs, which could provide certain rewards for community members, certain incentives, certain borrowing rates, certain percentages, increased percentages of the fee that we're taking as a platform. So I suppose everything is on the table, but what we want to do is we want to bring on board those key community members at the outset, get them engaged in our protocol, but get them engaged in what that reward system looks like. And we collectively will then define what that is, and we'll put that in place. And this isn't lip service to the idea of community we're rewarding. Okay, we're real about this because the fundamental concept of what we're doing, which is slightly different to what others are doing, is it's community and it's insight. So with that must go rewards, and it must be fair rewards and real rewards as well.
Okay, all right. So what do people need to do if they're interested in taking part in that?
Yeah, so I suppose the first thing to do is they can access our website, they can join our Discord, follow us on Twitter, but what we'd really like them to do is complete the registration form that's on our website.
Okay.
And decide if they're not fixed into these particular roles, but decide if they're a maker, a liquidity provider, or a shaker, a borrower. just from their past experience. Again, they're not fixing that, and complete the form. And then we'll be in touch within the next couple of weeks. And what we're going to be doing is, in terms of engaging, is we're going to be doing a series of one-on-one calls with them if they're comfortable. We're going to be putting out some questionnaires. We're going to do some group stuff as well. And what we're hoping is that alongside us leading and steering this process, is that there are some initial community members that want to and are supported in terms of taking other leadership roles, where they can start pitching the community's view as to what those things should look like. So that's the initial process, and that's the way that we're hoping to tackle this. And obviously people can hit me up, can hit us up with questions on Twitter or on the Discord as well. We're pretty active at the moment in terms of engaging people that have got questions on that. And we're really keen to get people's insights as well, over and above the kind of form filling. We're keen to just get raw insights. We've had a few people that are lending in this space. We've had a few borrowers that have given their particular take on what we're doing, and also our protocol, which we've drilled down a bit more into offline, not for today's kind of forum. And it's great for us to get that, because we know we don't have all the answers on day one.
It's great to speak to a project so early in this space that you're actually asking for community engagement in terms of building a thing, which I think is pretty cool. So if anyone listening, it's MakerShaker.xyz, and I've just looked at the website again now. It's super easy. You can scroll down and you can click on the form, and it literally takes probably 20, 30 seconds to complete. So it's not like you've got to put your life story in there. So if you're interested in taking part, make sure you go and do that and follow these guys on Twitter. It's been a really fascinating conversation to really sort of pick apart what you're trying to do and what some of the problems are. And it's certainly given me a lot of things to think about. Is there anything else that you've sort of wanted to finish on at all?
No, look, I've really enjoyed this conversation, guys, and it's been quite fluid, not structured, and that we've really enjoyed. It's given me an opportunity to kind of talk about some of the things that we're really excited about. I suppose the one thing, the one message which maybe I didn't portray so far is that look, it's that concept of why we've got involved in this space. I'm a big, so we are lending against blue chips as they exist today. As I've mentioned earlier in the call, I'm involved with the Yuga Labs ecosystem as an owner of assets, and not only as my PFP, a mutant, and a load of other deeds. So we're big fans of what this space looks like at the moment, okay? But what we really got involved for is what we think that this space could look like in the future. And so we're not just interested in onboarding people that already are borrowers or lenders in this space. Okay, we're also interested in engaging people and future-proofing what we build at the outset. Obviously, we're going to iterate, okay, for sure, and iteration could be something bit more than iteration as we go forward. But we're also interested in engaging people that aren't active in this space, but are interested in what the future could hold in terms of tokenized assets. So that could be tokenized real estate, cars, that could be tokenized human capital, across the range of what NFTs could look like in the future. If those people are interested in engaging us, we'd love to involve them, okay? Because that really is our big vision, and that really is and it's not just our vision, it's the vision of lots of people in this community, but it's really the driving force of why we've got involved in this space, because we see there's an opportunity here to be the infrastructure play for providing liquidity across a whole range of assets. And what we think is important in terms of us getting involved in that and bringing our skill set to it is in order to onboard the next wave of users, the next million NFT users, the next 10 million NFT users, there's got to be liquidity provided, and it's got to be fair to people, because the idea of assets, large-scale assets being tokenized, they're not going to be accessible to people. And that's across blue chips as well, right? Okay, some of the blue chips less expensive today than they were 3 months ago. But for the average person, a blue chip is still expensive. So if we're able to provide liquidity to them, we can onboard another wave of users into this space, get them involved in it, and that's positive for the community as a whole. So I suppose that's the big vision, and that's what we're trying to do in a positive way to help everybody involved in this space. We're not just trying to carve out our own niche. We're trying to help the whole ecosystem.
I love that. That's amazing. I think we'd definitely love to have you back on the show when, maybe in 6 to 9 months, or whenever we think's most appropriate to talk about what the first version of the product is and the platform is. So thanks so much for coming on, and I think I've learned a lot. I'm sure you have as well, Ben, actually. It's given me a lot to think about.
It's been an absolute pleasure. Yeah, it's good. It's something which I think about often. And just to pick up your point, Martin, talking about sort of the future of NFTs, when I have these conversations, people assume that NFTs are just these JPEGs in cyberspace. And the fact that actually, this technology could, really tokenize everything and make markets much more efficient and digital ownership much more efficient. And as you rightly said, there will need to be liquidity provided. So I'm excited to follow your journey. And as Kevin said, we would love to have you back on the show in 6 to 9 months to hear about your progress.
That's brilliant. Look, thanks for having me, guys. I've really enjoyed it. Appreciate it.
Thank you. Thanks.
We hope you enjoyed this episode. It would mean the world to us if you could leave a review wherever you're listening. This really does help and allows other people to find us online. You can keep up to date with new releases of the podcast by subscribing and following us on Twitter or Instagram for the latest crypto-related news. Information provided by Crypto Pulse via this podcast, website, social media channels, and any other medium does not constitute financial advice, investment recommendations, or any other type of advice whatsoever. The Crypto Pulse team are not professional financial advisors. Trading and purchasing cryptocurrencies do carry risks, and anybody wishing to partake in such activities should seek professional advice.